Hello friends, welcome to CEC Live Lectures. Friends, with our ongoing series on financial accounting, today we are going to talk elaborately on journalizing. We are going to discuss what journalizing is, as well as we are going to discuss journalizing with the help of some suitable examples too. And for this discussion on journalizing, we have with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting and she is teaching in one of the leading management schools of a leading institution in the country. She is a certified management accountant from USA and has authored numerous books. A number of her articles have been published in reputed journals too. A number of students have pursued their PhD under her able guidance, and she, through the help of this live platform, always believes in giving her utmost knowledge and experiences to the students. Friends, if you want to ask questions from Dr. Kaur, then you can call us through our toll-free number. You can contact us through the number 1-800-110-430. I repeat, our number is 1-800-110-430. All friends are requested to call in the last 10 minutes. Now, I would like to request Dr. Amarjeet Kaur to start today's lecture on journalizing, and we believe that you are going to learn a lot through her. Hello ma'am, welcome to the lecture.
Hello, Kritika. A very good morning to viewers and welcome on yet another lecture in financial accounting. As has been introduced, that topic would be journalizing. We are going to discuss what is a journal book, how do we carry the journalizing process, and then thereafter we will solve few transactions. We'll put them in the journal book. So let's recall our discussion on the day one when we started this series and where we introduced what is financial accounting. So financial accounting is basically, as we know, is a branch of accounting, and we take it as an art and science both. So it's more towards art of recording, right? Then posting. Then we analyze it, interpret it, whatever is happening in the business. So basically, financial accounting is treated as an art to record business transaction, an art to post business transaction, and then to summarize business transaction, and then thereafter analyzing and interpretation of business transactions. So primarily, today we are going to emphasize on the first part of the definition, which says this is an art to record, so recording part. So that would be the agenda. So I wanted to establish a link in your mind that, accounting is primarily generating economic information. So it is towards bringing out data in a way that it is useful to all. We discuss about users. So there are users, either the owners are there, shareholders are there, government is there, bankers are there. We have prospective shareholders, labor unions. So many users are there of financial information, and we have discussed them in length in the past lectures. And thereafter, in the immediately last lecture, we talked about accounting equation and rule of normal balance. So normal balance rule we would be referring to again in today's discussion. So keep that concept in your mind, and it should be handy in case you took the notes. So let's go back to the recording one. So I'm saying financial accounting has many functions, and first and the foremost function is recording. Recording means when we understand that this particular transaction is a business transaction. We know that all transactions cannot be featured as business transactions. Few of them may be just a transaction but are not business transaction. Either they do not involve any monetary or money part in it, or they are just qualitative in nature, right? Unless or we do not have any proof for them. So unless a transaction is can be defined in quantitative terms and it is supported by some documentary proof, we cannot record a transaction in our books of accounts. So two things are essential. One, I am repeating, the transaction should be a business transaction having some quantitative part in it. Either in part or in full, the transaction can be taken in monetary terms. One, right? The second thing, we have some documentary proof for the transaction, because unless we have some documentary proof, we cannot record the transaction in our books. These are the two essentials. Okay, so once we know that a transaction is a business transaction and we are bound to record it in the books of accounts for the purpose of preparing financial statement, the next question is, where do we record? So we record in a book named Journal, Journal. So this book Journal is the prime entry book, the book where we record the transaction for the first time. So a book of prime entry, this is how we generally know this book as. Then we record it for the first time in this book. And then another thing is that in this book we record in a chronological order, means with the order of their happening, date wise. In a simple word, we record transactions in this book date wise. So three important things are coming up. This is the book of prime record, prime entry. We record in chronological order, and we record for the first time, and thereafter this book precedes the next book, which is ledger. Thereafter we post. We carry the second function of accounting, which is posting. So the agenda, as it's only the recording part for today, posting would be in future lectures. So let's restrict to our discussion to recording only. So once we know, you can have a look at this slide, which will give you a little idea that what does we mean by the journal book. So you can have a look at the slide if you are taking the notes. So as I said, a book of prime entry, transactions are recorded for the first time. Transactions are recorded in chronological order, and the act of recording is known as journalizing. So kindly mark it. This is very, very important. So journal is the name of the book, and the action part, when we are recording in the book journal, it would be known as journalizing, right? So this is the basic discussion. Now let's discuss about business transactions first. Business transactions, if you were with me in the last discussion, we said the transaction for the purpose of financial accounting are grouped into three parts, right? Transactions, number one, pertaining to the real things, for example, land, building, furniture, etc. So they are put together under one category, under one class, and the accounts which pertain to them are known as real accounts. Okay. The second type of account which we discussed is belonging to the transactions, or which records transactions pertaining to real human beings or artificial persons. So we call them as personal account. So either the real person like you and me, or the artificial person like a bank, a company, etc. And they are known as artificial person. So all, if we put them together, we relate them with the account named personal accounts. The third class of transactions which are grouped together belongs to either expenses or revenue. So, and they are known, and they are put together and under one category known as nominal accounts. So we have three set of business transactions, and they are similar nature of transactions, so they are grouped together, right? And then we discuss the three accounts pertaining to each category or each class of business transaction. Okay, accordingly we have personal account, we have real account, and we have nominal account. Why I am pointing out them again today, and especially in the context of journalizing, I have a purpose, of course. So the objective of pointing out those three classes is because we said, because of the classes we have types of accounts, and for each type of account we have a different way, a different rule. We call them as rule of debit and credit. a different rule of debit and credit pertaining to each category of the account we discussed. For real account, we have a different rule of debit and credit. For personal account, we have a different rule of debit and credit. And for nominal account, we have a different rule of debit and credit. Right? So, because of this, there are three rules. So, now everything falls in order. Number one, we said we are grouping transaction, that is a man-made action. It is not, and this is not coming from any natural resource. We as professionals or of accountants, we divided transactions into three categories. Each category has its own set of accounts known as real, personal and nominal, and then each type of account, real, nominal and personal, they have their own rules of debit and credit. And what are these rules of debit and credit? These rules are basically the guiding lines that they guide us that how to record the first function, the journalizing, right? How to record a transaction into the journal book. So we are doing journalizing, which is the act of writing the journal entry into the journal book. So journalizing is actually guided by these rules. This is one way to look at the journalizing part. Another way, this is what most of the Indian books would show. I would, with the God's grace, I have exposure in international teaching as well. So there I have never seen these three rules, which are known as golden rules of post recording or accounting. There we follow the normal balance rule. The normal balance rule of each type of account or each type of element we use in the financial statement, which was discussed in the last lecture, they use that rule. So while since this is my responsibility to help you understand or give you the best exposure, I would try to discuss both the rules, the golden rules of accounting, which is the debit and credit rules, and normal balance rule together with the help of same example, right? I think that will help you to learn both the things, and then you can decide after this lecture that which particular rule, which particular method of recording you want to adopt. You want to follow the normal debit and credit rule, or you want to follow the normal balance rule. Alright, so now let's discuss about those three rules first. Normal balance rule has been discussed in the last lecture. I will just refer them again today once we are done with these three rules of debit and credit. So as I said, we have three types of accounts: real accounts, personal accounts and nominal accounts. So for real accounts, the rule is, real means a building, a land, a furniture, fixture, etc. So real account rule says whatever is coming in should be debited. Whatever a real thing is coming in the business should be debited, and whatever a real thing is going out of the business should be credited. So accordingly, we say debit what comes in and credit what goes out. This is how the rule has been defined in most of the books. So I will repeat: debit what comes in. And when I am saying comes in means what? I am referring to a real thing. Real thing, as I said, could be land, building, furniture, fixture, cash, any such thing. So any real thing coming in to the business. When I am saying coming in, I am referring from the business perspective, not individual perspective. So from business perspective, whatever is coming into the business should be debited. Whatever the real thing is going out of the business should be credited, right? This is the first rule. The second rule is pertaining to the second type of accounts, which is personal account. And personal account says, the rule says, debit the receiver and credit the giver. Receiver means who is receiving anything. So if there is anything which has been exchanged, so whosoever is receiving it should be debited and credit the giver. If somebody, so it's giver from the business perspective, receiver from the business perspective, right? The third rule is pertaining to nominal account. So nominal account rule says debit all expenses and losses and credit all revenues and gains. So if there's an expense going up, right, some wages are being paid, salaries are being paid, so debit all expenses and losses, credit all revenue and gain items. So this rule is pertaining to nominal account, because nominal account means all transactions which belongs to revenue and expenses. This is what we already defined. So if you can actually make a picture in your mind, you can correlate very well that we have one first beginning point, that at the number 1 we have business transactions which are grouped into 3 categories, right? Each category has its own kind of account, so accordingly 3 types of accounts, and each type of account has its own debit and credit rule, so known as rule of debit and credit, golden rules of accounting. Okay, so you can have a look at this slide if you want to note down or otherwise. So these are the rules. The business transactions, as I said, are divided into 3 groups or parts, and separate rule of recording for each group and each type of account is indicated here. For real account, debit what comes in and credit what goes out. Personal account, debit the receiver and credit the giver. And nominal account, debit all expenses and losses and credit all revenues and incomes, right? So keeping this discussion in mind, I think conceptually I'm done with the concept part. I should be referring to some example now to help you understand the practical part. So have a look at the slide here. It is showing you that how does a journal book look like, a journal entry may look like. So a typical journal entry would be there in the 5 columns. I have purposefully made 4 columns here, and we would be using 4 columns in the next examples as well. But in most of the books and otherwise, we may draw a 5th column as well, which would be having a title as LF. So this is a normal journal book. The first column, as is been indicated here, shows the date. The second column is description, particulars or detail. You are free to use any word. You may use description word as is here. You may use detail word, or you may use particulars. In most of the Indian books, word particulars is used. In most of the foreign books, description word is used, right? The third column here on this slide is debit. So it indicates how much amount is to be debited and which account is debited. The fourth column on the slide is credit. So this indicates which particular account type is being credited, or the name of the account which has been credited. At the bottom, these are the 2 accounts which are debited and credited, which cash and paid in capital. And there, if you read, this line is important: to record an investment by owners. So it is indicating, and it is known as narration. It is indicating, it is giving us an idea that there was an investment by owners, which means a capital has been brought in by owners of the business. So a business has received some money in the form of capital from owners, right? So this is known as narration. Narration is very, very important, because whenever there comes an issue when we are not able to match 2 accounts, when there is a question mark by auditors, or otherwise a scrutiny is required in the account books, then this narration helps us, because this gives us a basic and the first idea that why has this particular transaction been recorded, right? So this narration could begin with the word to. It's a general practice. There is no restriction on language. First of all, let me clarify this point. But it's a matter of practice. There are 2 kinds of practices. One is that we generally use being word to begin the narration. So being capital invested by owners, being capital brought in by owner P, owner X if it is a partnership company. So either being or the word to investment made by owners. So you are free to use any words later on. In the beginning, preferably we should be using the standard practice as we have, either the word being or the word to. Other than that, if you notice, the cash was on the left hand side, whereas here, so cash is here on the extreme left of the column. So if this line is indicating the column, right, this cash is just by the side of the line, whereas this credit part paid in capital is far behind, or rather is after a tab, so it's not beginning near the wall, near the line. It is beginning after some points, after some tab, right? So this is known as indented. I will show you in the next slide that how do we indent. This is called as indenting. So this is a matter of practice in accounting, that we always write debit on the extreme left side of the column, and we indent the credit side of the transaction. Whatever the account is to be credited should be written in an indented form, right? So let's have a look at this particular slide, and here I have indicated all the points I am actually referring to. The same transaction, that was an example only. Cash debits are written first, so that's what I wrote I discussed here. In the date column, we generally may write 30th June. If it is 6 by 30, it could be 30 by 6 by 2017, right? You can write the year as well. So you may write 30th June, so 30th/6/2017. So then in the so this is the date is for the purpose of reference of the transaction, on which date, because if you remember, I just said we need to record transaction in chronological order. So it means putting the date becomes very, very important. It's imperative to generalizing function that we record it in chronological order. This is the requirement by law. So date is there. Then the second thing, as I said, debits are written first, and then credits are indented. Here my cursor is indicating that. So if you chase my cursor, that's what I'm discussing. So we intended, so from this to this point, if you follow my cursor, there's a gap of about an inch on this slide. So paid in capital has been credited but has not been written just below the cash. It has not been written so, rather it is in the indented form, right? So we write credits after the debits, so they are intended form. So total of the debit must equal to the total of credit side. So whatever the amount we debit, the similar amount in total should be credited. Why I am saying in total? Because there is a possibility to have more than 2 items or debited, more than 2 items credited, right? Or it could be any number of items debited or credited in opening and closing entries, which we will do in the next lecture. So this was the basic discussion on generalizing. Now I shall be taking few examples which we will carry till the next half of the discussion. So here are certain business transactions noted down for you. The first one says the owners invested $2,000. The second says company borrowed $6,000 from a bank. The third says equipments costing $10,000 was purchased for $2,000 in cash and signing a note payable for the remaining amount of $8,000. The fourth says equipment that cost $3,000 was sold for $3,000 and the $3,000 will be received within 30 days. The fifth one says company provided services for $8,000 and received cash. And the last one says wages of $2,000 were paid in cash, right? So these are the transactions, and now we will take one by one all of them, that how do we record it. So the first one says owner invested $2,000 in cash. So as I said, we will review the transactions from two angles with the help of two tools. One with the help of debit credit rule, the golden rule. The second with the help of normal balance rule. So what is happening? Let's review. The transaction was owners invested $2,000. So $2,000 is cash, right? So 2000 is real thing, is coming into the business. So as per the golden rule, the real thing if coming into the business, so debit what comes in. This is what I discussed. So it means cash would be debited because it is a real thing and it is coming in the business, right? So credit what goes out, the second part is not real thing. Who is giving us? A person. Owners are persons, right? So owner's capital is known as representative personal account, the third category of personal account, or owners are persons. So we can, if there's only one owner and it is a firm, we can simply use the name of the person instead of capital, or the best way would be to write the name of the owner along with the capital. P is capital, X capital, D is capital, right? Whosoever is giving. So capital is something, is a personal account. So P is capital is basically representative personal account. So who is giving? A person is giving us. So what is the rule of the personal account? Is debit the receiver and credit the giver. So owner becomes a giver to the business, right? So accordingly we should be crediting P is capital, A is capital, whosoever is giving. So this is as per the golden rule that debit what comes. It means first lesson is what? If you are learning accounting for the first time, it's not that easy. We have to pay attention on the details, and the details are that in this particular transaction, two types of accounts were involved. One was cash, the cash was coming in, so we have to analyze the transaction first before recording. So we are analyzing now. So cash was involved, cash is a real thing. And second thing was some person was involved, and the person was owner here. And owner is giving us some money, and money given by owner is known as capital. So owner's capital becomes representative personal account in accounting definition, in accounting literature. Okay, so this is how we should be analyzing a transaction. So accordingly, two types of accounts were involved, real and personal, and we debited cash because cash is coming in, the real thing is going up, so debit what comes in, and we credited P's or A or capital account because this represent a personal account and person is giving, so credit the giver. So with the help of golden rule, this is how we did. If the same transaction were to be analyzed with the help of normal balance, so cash is what? Cash is an asset. The normal balance rule which we discussed in the last lecture was based on the elements. So we have 5 elements. We have assets, liabilities, capital, revenue and expenses. These are the 5 important elements in financial statements. So the cash, the first element involved in the transaction is what? Asset. Cash is a current asset. So assets going up should be. So assets have normal balance as debit. So if the normal balance means by the side, debit or credit, by which side the increase should be recorded. So for assets, the increase is recorded by debit side, right? And the personal account, the capital has the normal balance as credit. So if we have to record the capital, if we have to record the increase in capital, it should be credited. So that's how we follow the normal balance rule. So the same transaction we analyzed and we recorded with the help of both methods we can use in recording. I hope you were able to gather this. Thank you very much for being with us for this half an hour. Thank you.
With this note, thank you, ma'am. Thank you so very much for explaining us in detail what journalizing is. Friends, as Dr. Amarjeet Kaur herself said, that we would be continuing further and will be discussing journalizing with the help of some examples. So be with us. We are back after a short break. Hello friends, welcome back to this session where we are discussing journalizing. We have already discussed what journalizing is, and as we promised to explain you journalizing with the help of examples. So here we are, and we have with us in our studios Dr. Amarjeet Kaur. I would like to request Dr. Kaur to continue further and explain us journalizing with the help of examples. Over to you, ma'am.
Sure. Thank you, Geetika. Welcome back. As has been discussed earlier, that we shall be practicing a few transactions in journalizing in this half. So let's start with the second transaction, which I just showed you a few minutes ago. The second transaction on the slide is the company borrowed 6,000 from a bank. I am referring to number B, right? First we have already discussed. So number B says the company borrowed 6,000 from a bank. So let's discuss this. So what is happening? Your cash is coming in, you borrowed, you as a business borrowed, right? So if you borrowed, cash is coming in the business, so cash is going up. And where did you borrow from? A bank. And bank is an artificial person. So who is giving you that cash? A bank is given. In the first example, 2,000 was coming from owners. Here in this transaction, 6,000 is coming from bank, and bank is an artificial person. As far as first part of the transaction is concerned, it's very much same like the first one, where the cash was debited. Since the cash is a real thing, and real thing is coming in, so debit what comes in. The rule is debit what comes in. So we shall be debiting this cash of 6,000, right? What should be credited? We have to credit the same amount, of course. As I said, debit and credit remains the same. But what should be written? We are issuing notes payable. So we received from bank, right? So who is giving us? A bank is giving us 6,000. So we may issue notes payable, and that's why the notes payable would be credited. So you would be writing cash debit and notes payable credited. In the narration, I have purposefully left this line blank at the bottom, the third line in the second column, so that you could think what should be the narration. We can discuss. The narration should be being loan borrowed from bank, and if the name of the bank is known to you in the transaction, that should be also written XYZ bank, right? Or to, you may start with to, as I said, to record loan borrowed from X bank in cash. So loan borrowed in cash from X bank, because loan could be in the form of some other instrument as well, financial instrument as well, right? So this is how the second transaction should be recorded as. Now let's have a look at the third transaction. Third was equipment costing 10,000 was purchased for 2,000 in cash and signing a notes payable for 8,000. Now what is happening? This was the first, this is the second one, and let's come to the third one. That transaction says equipment costing 10,000 was purchased for 2,000 in cash and signing a notes payable for 8,000. Now let's analyze the transaction from golden rule perspective, and thereafter with the help of normal balance. As I promised, we will discuss from both the perspectives. So equipment is coming in, it's been purchased, right? So equipment is coming into the business. So equipment is what? Equipment is a real thing, right? Plant and machinery and equipments are real things. They are non-current assets which help business to operate. So they help us in our business operations to generate revenue. So real thing is coming into the business. So the golden rule says debit what comes in. This is for the real accounts. So the golden rule for real account is debit what comes in. So we shall be debiting 10,000. Okay. Now in the credit, what is happening? What is going out? A cash of 2,000 and a promise of 8,000. So we promise that we will pay you 8,000 later, and we are paying you 2,000 cash today. So cash is again a real thing. A real thing is going out of the business. So as per the real account rule, the credit what goes out. So we should be crediting it. And then the last thing is that we are promising. So this is also a real thing. Debit what comes in and credit what goes out is not only for assets, it is for liabilities as well. So liability is also a real thing. This is a reality. So our liability is going up, right? So debit what comes in, credit what goes out. Your promise is going out. Or other way to look at is this. This is a kind of representative personal account. This represents, debit the receiver and credit the giver. Somebody who has given us the money. He has given us the equipment. So someone may analyze it from this perspective, but this is a real thing. From the best of my knowledge, it should be credited from that perspective. So we should be crediting notes payable 8,000, we should be crediting cash 2,000, and we should be debiting equipment because we purchased equipment. So what should be the narration? The narration should be being equipment worth 10,000 purchased for 2,000 cash and 8,000 promise or notes payable. So this should be your narration. So this was from the debit credit rule. Now let's look at the same transaction from normal balance rule. So there are three things involved in this transaction. One, equipment. Second, cash. And third was notes payable. So as I said, cash and equipment, they both are your assets. But equipment is going up and cash is going down, right? We paid cash and we received equipment. From a business perspective, my equipment is going up, my cash is going down. And the normal balance of an asset, and they both are assets, normal balance of an asset is what? The normal balance is that we have to record an asset in the debit side if it is going up. So my equipment is going up. From the business perspective, the equipment is going up. If it is coming in, means my value of equipment in my records is going up. So it should be debited as per the normal rule. The normal balance says assets have normal balance of debit, and which means normal balance means the side which is used to record an increase. So increase in equipment should be recorded in the debit side. So and the decrease in asset side should be recorded in the credit side. So any decrease in any asset should be recorded in the credit side, and cash is an asset, and cash is going down. So decrease in an asset should be recorded in the credit side. So accordingly, we would be crediting 2,000 and we would be debiting equipment of 10,000, and they both pertain to the first important element, and that is assets. Now if I discuss it, the third variable in this transaction, and that was notes payable. And notes payable is a liability, again a real thing. So liabilities should be credited for, the normal balance is credit. If we have to record an increase, if we have to record an increase in liability, it should be credited, right? And if we have to record a decrease in liability, it should be debited. It's always other way around. It's always inverse. Okay. So since my liability, the notes payable for the company are going up, they are increasing, so I should be crediting it. So from normal balance perspective, because liabilities have credit normal balance, and normal balance means which side we record increase. So to record an increase in the liabilities, we always use credit side. So from that perspective, this is how you should be analyzing this transaction. Okay. Now let's move further and look at the another transaction. The another transaction says equipment that cost 3,000 was sold for 3,000, and this 3,000 will be received within 30 days. So you did not receive cash, right? It's saying you sold an equipment. So let's analyze it. So let's analyze this transaction now. Your equipment in your books is going down because you sold it. So the equipment physically as well as an actual in books would go down. Okay. And against that, we sold it. We did not receive cash. We rather received a promise which is known as accounts receivable. right? That we would be paid after 30 days. Okay, so how should we deal with this transaction? From normal balance rule, first of all, let's analyze which are the accounts, type of accounts involved in this transaction. One is equipment, which is a real thing, an asset. Another is your promise, receivable. So again, that is a real thing. These are the two accounts involved. Both that accounts involved are real. So none of the personal account, none of the nominal account is involved here. Okay. So what is happening? One real account rule says debit what comes in and credit what goes out. So my equipment is going out. Debit what comes in, credit what goes out, right? It means the equipment is going out worth 3,000. I should be crediting equipment for 3,000. And then debit's rule of a real thing is debit what comes in. A real thing is coming in because we are getting a billed receivable, that is a promise, that is an asset, current asset for a business. So a promise is coming in, a real thing is coming in. So debit what comes in. So bills receivable would be debited, equipment would be credited, and the narration would be being equipment sold on credit. Right? We are selling the equipment on credit. We did not get cash. We sold it on credit. So this is how it should be narrated as. So this is how we actually record transactions by analyzing and applying golden rules of debit and credit. Now the same transaction, if we want to analyze from normal balance rule, I am teaching you two things parallelly with the help of same example. And I hope you are able to comprehend both of them. Now if I have to apply the rule of normal balance, what would we do? As I said, we have to see, which particular element of financial statement is involved. Asset or liability, capital or revenue or expense, those 5 elements. Equipment is also an asset, and the bills receivable, because we received a promise, so that is bills receivable, is also an current asset. So both the element involved here are assets. And what is the normal balance for assets? Is debit. Debit for increase. So what is increasing? Receivables. So receivable should be debited. What is decreasing? Your equipment. So equipment should be on the credit side. So this is how we apply normal balance rule for the same transaction which we discussed with the help of a debit and credit rule, golden rule of accounting. Okay, let's move to the next one now. The next one says company provided services for 8,000 and received cash. So we are providing services and we received cash against that. So let's discuss this now. What is involved in this transaction? We as a business, we extended services to somebody and they paid us 8,000 in cash. So cash is coming in. Cash is a real thing, right? A real thing rule says debit what comes in and credit what goes out. But the second part, so one part is cash. So cash is coming in, so it would be debited. But the other part of the transaction is that we are extended services for somebody and we are generating revenue out of it. So this is a sales revenue. And revenue is a nominal account, right? So the rule for nominal account is, so two type of accounts involved in this transaction. So let's analyze that. One is the real account, which is cash, and the revenue is your nominal account. So the two type of accounts which are involved are real and nominal. Okay. Since the cash is coming in, so rule says debit what comes in. The real account rule says. And the second is your revenue is going up. So the rule of nominal account revenue says debit all expenses and losses and credit all revenues and gains. Since my revenue is going up, it should be credited. So this is the sales revenue and it should be credited. So this is as per the rule of debit and credit. The second part of the recording is that we have to narrate it. So the narration would be services extended on cash basis. So or sales revenue generated on cash basis, because services are also a kind of sales too, because if you are into services business only, that is your sales only. So sales revenue is to be credited, and this is how to be narrated. So this was from debit and credit rule perspective. If we look at the same transaction from normal balance rule, how would we look at it? Recording, the answer would be same, which is there in front of you, which we already know. But now we need to analyze from the normal balance, and we need to analyze from the elements perspective. So which element is involved? So element involved is cash, because cash is coming, which is an asset, and the element involved is revenue. So the normal balance for asset is debit, right, to record an increase. So this 8,000 is debited from that perspective, and the normal balance for revenue is credit. And since the revenue has gone up, to record the increase in revenue, we should be crediting it. So this is how we analyze from normal balance rule. It's up to you to decide. You want to use the debit credit rule, you need to remember that, or you want to use the normal balance rule, you need to remember that. There are 3 rules of debit and credit, and there are 5 elements to apply normal balance rule. Alright. Moving forward, let's take another transaction. This transaction says wages of rupees 2,000 were paid in cash. So this is the another transaction. Here wages are paid in cash. Okay. So let's analyze from the perspective of normal balance rule as well as from the debit credit rule. So let's see which 2 type of accounts are involved in this transaction. The first type of account involved is cash, which is easily to identify. So we are paying in cash. So that is asset, right? So real thing, asset is a real thing. So first type of account is real account. Second is wages, and wages are expenses, of course we are paying. So and expenses are the third type of account, which is nominal account. So 2 type of accounts involved in this transaction are real and nominal. So this should be your first thing to analyze any transaction given to you to solve. Now after that we have to remember the rule of debit and credit for each type of account. So the 2 accounts involved are real and nominal. For real thing, the rule is debit what comes in and credit what goes out. So here cash is going out, it means it should be credited. So debit what comes in, credit what goes out. Since cash is going out of the business, it should be credited. And the second type of account which is involved here in this transaction is nominal, and the rule for nominal account is debit all expenses and losses and credit all revenues and gains. So we have expense going up, so wage is an expense, so it should be debited. So accordingly our answer should be, we would be debiting wages, so wages to be debited, and we would be crediting cash. So wages should be written on the left and extreme left of the description column, whereas the cash should be intended. So that's how, this is how the transaction is recorded. And date I am just purposefully left blank. We have to record because I am not mentioning any date, so that's why the date column is not anything is written in the date column. In the description column, you note down this thing, wages are starting from the extreme left side of the row, whereas cash is after some space. So they are indented, right? So cash has been intended description, and then amount, same amount has been debited and the same amount has been credited. So this is how we record transactions with the help of either normal balance rule or with the help of debit credit rule of 3 types of accounts. Now I will show you a few more transactions and you can note down those transactions. You can take a picture of that transaction so that you could practice, because I am not going to show you answers to this transaction. This is just to help you practice later. I will discuss only 1 or 2 transactions as per the time permits. So let's take the first transaction. Purposefully I have recorded I have recorded date as well in this slide. The last few examples were without date. Now the second thing you need to learn, that we must record date as well, because generalizing is always in chronological order. So the first transaction happening on January 1st, you can assume any year for the purpose of practice, and it says XYZ Limited started business with cash. So let's analyze this transaction and note down the second one. So we may be able to analyze only 2 or 3 transactions. So XYZ started business with cash 15,000. This is very much similar to the first example we took a few minutes ago. Here business name is XYZ Limited, and the business has started business with the help of cash. So cash is coming into the business, which is 15,000 is a capital, right? Cash invested by owners is always capital. So cash is coming in. Cash is what? A real thing. So you have to look at the transaction, which 2 types of accounts are involved. And second is, somebody is giving you capital. Capital is representative personal account though, but it's raising your liability. Business has to pay back to owners at the time of liquidation or otherwise on demand. So both are the real things. One real thing is going up, another real thing is also going down, because your capital is coming in. It's a liability. So liability is also a real thing, and your cash is also a real thing. So debit what comes in, credit what goes out. Liability is a promise that you are promising that I will pay you later. So based on that, you would be debiting cash of 15,000 and you would be crediting the name of the person along with the capital who brought this capital in the business. It could be Mr. X capital. If it was XYZ Limited and there are 3 partners assuming X, Y and Z, so we will say X capital because X is bringing in, Y is bringing in, then it would be written as Y's capital. Okay, in the narration you will write capital brought in by X. This is how you should, and in the date column you should be writing January 1st, 2017. So this is how we generally record. If the time permits, we can take one more transaction, and the second transaction is on January 3rd, and this would be the last transaction to discuss. It says bought goods for cash. So the business has purchased. So the bought goods worth rupees 1,000 in the last column here, a row here, 1,000 is there, right? And for 1,000 in cash. So let's now discuss this transaction. We are purchasing goods. So goods are coming into the business. Goods are real thing. So inventory is going up, right? And cash is going out. So cash is also a real thing. So the both elements involved in this transaction are real. And the rule of real account says debit what comes in, credit what goes out. So it means you should be debiting goods. We generally do not write the word goods. We have a practice to use purchases or inventory. So you should be debiting purchases and you should be crediting cash because cash is going out. Credit what goes out. Cash is going out. So this is just, so the best way to analyze is to find out first of all which type of account out of the 3 are involved. Second, recall the rule of the debit and credit, and then third, apply it. So follow these 3 steps and you should be good in recording business transactions. I hope you were able to gather the concept of generalizing and the rules of debit and credit, and also a new thing which is hardly there in Indian books, which was normal balance rule to record transactions in the journal book. Thank you very much for watching this show today. Thank you.
With this note, thank you, ma'am. Thank you so very much for giving us a precious session. Dear friends, you can give your feedbacks and suggestions on info.cec@nic.in. We would be meeting again very soon and would be discussing further. Till then, take care. Goodbye. Thank you, ma'am. Thank you once again.
Thank you. Thank you, viewers.